Look at your last paycheck, not the gross income. The net income. The gross income is what you earned. The net income is what they left you. Federal income tax, state income tax, Social Security, Medicare, FICA. Each one with its own line. Each one with its own percentage. Each one calculated and extracted before the deposit hit your account, before the money had a single second to be something you decided what to do with. You didn't negotiate any of this. You weren't consulted. You showed up. You traded the hours. The government ran its formula on what it was owed, took the result, and deposited the remainder into an account you've spent your entire working life being told to be grateful for. This video is about 4 legal structures that exist in 2026 to reduce, defer, or completely eliminate what the government's allowed to take from your financial life. One requires moving to a place most people haven't ever thought of as a tax strategy. One uses a program the government created to develop low-income communities as a vehicle for eliminating capital gains entirely. One is a legal document that's most valuable if you die earlier than expected. And one's been available to every American investor for over 100 years. And most people dismissed it before they finished reading the first sentence about it. None of these are illegal. None of these are hidden in the sense that they were concealed. They're in the code. They're being used right now by people who were told about them, or who read deep enough into the right documents to find them. You're about to be told. Before the methods. One thing that explains all of them. The tax code wasn't written to be neutral. It was written by people with assets, to protect people with assets. Earned income. The money you receive for showing up, trading time, and performing a function someone else decided was worth paying for, is taxed at the highest rates the American tax code produces. Passive income. The money generated by things you own while you're somewhere else doing something else entirely is taxed at lower rates, sometimes at no rate at all. This distinction isn't incidental to the tax code. It's the architecture of the tax code. And 4 structures inside that architecture are available to you right now. Method 1, Puerto Rico Act 60. Here's a fact about Puerto Rico that most Americans either haven't ever encountered or encountered and immediately dismissed as something that applied to someone else. Puerto Rico is a territory of the United States. Puerto Rican residents hold American passports. They're American citizens. They carry American legal protections. They travel domestically without crossing a border. But under Section 933 of the Internal Revenue Code, a provision that's existed since 1954 and has been operating exactly as written for 70 years. Bona fide residents of Puerto Rico are exempt from U.S. federal income tax on Puerto Rico-sourced income. In 2019, Puerto Rico enacted Act 60. Under Act 60, individuals who establish genuine, documented residency in Puerto Rico pay 0% capital gains tax on all appreciation that accrues after they arrive on the island. 0. Not reduced. Not deferred. 0. You move to Puerto Rico. You establish residency. You buy stock. The stock goes from $10 to $200. The $190 gain isn't subject to federal capital gains tax. You build a business. The profits generated there are taxed at 4% rather than the rate you'd pay on the mainland. You keep your American passport. You keep your citizenship. You don't leave the country. You move to an American territory that the tax code treats as a foreign jurisdiction, and your capital gains effectively cease to exist. The IRS is aware of this. The strategy requires genuine relocation, 183 days or more physically on the island, a local driver's license, local bank accounts, local voter registration. For the person who treats this as a paperwork exercise, the IRS will end it badly. For the person who actually moves, the remote professional, the investor, the entrepreneur, Puerto Rico is the single most powerful domestic tax optimization tool available to a U.S. citizen in 2026, and the window's closing. New legislation passed in 2026 changes the rate for new applicants filing after January 1st, 2027 from 0% to 4%. If you're going to move, the time to file is before December 31st, 2026. After that date, the 0% rate locks out for anyone who hasn't already established their decree. Method 2, Qualified Opportunity Zones. In 2017, the Tax Cuts and Jobs Act created the Qualified Opportunity Zone program. The stated purpose: move private capital into 8,764 designated low-income census tracts across all 50 states by offering significant tax incentives to investors who reinvest capital gains into those areas. It worked. Capital moved. And the structure the government built also happens to be one of the most effective capital gains elimination mechanisms in the American tax code. Here's how it functions. You sell an asset: real estate, stock, cryptocurrency, a business interest. Normally, that gain's taxable in the year the sale occurs. Instead, within 180 days of the sale, you reinvest those capital gains into a qualified opportunity fund, an IRS-certified investment vehicle. If you hold your qualified opportunity fund investment for 10 years or more, the capital gains tax on any new appreciation generated inside the fund's completely eliminated, not deferred, not reduced, eliminated. You reinvested a $300,000 gain. That investment grows to $700,000 over 10 years. The original $300,000 gain becomes taxable at the recognition date. But the $400,000 of new appreciation generated inside the fund across the 10-year holding period? Zero tax. Under new 2026 legislation, the Opportunity Zone program's been made permanent. A new map of designated census tracts takes effect January 1st, 2027. Sell an appreciated asset, reinvest the gain within 180 days, hold for 10 years, and pay nothing on the new appreciation. The government built the structure. You're allowed to use it. Method 3, the self-canceling installment note SCN. This one requires the most careful explanation of the four. When a family with significant assets wants to transfer wealth to the next generation, a business, a real estate portfolio, a substantial investment account, they face a specific problem: estate tax. The federal estate tax applies to estates above the applicable threshold, and the tax rate can reach 40%. The self-canceling installment note. The SCN addresses this problem through a structure that's completely legal, documented in tax court history, and almost completely unknown outside the offices of estate planning attorneys who serve high net worth clients. Here's the structure. You sell an asset to your child, or to a trust established for your child's benefit. Not as a gift, as a genuine sale. Fair market value, a reasonable interest rate, an installment payment schedule over a defined term. Because it's a sale, no gift tax applies, and the asset isn't included in your estate at its full value. Here's the provision that defines the SCN. The promissory note contains a self-canceling clause, a provision stating that if you die before the note's paid in full, the remaining balance is immediately canceled. Your child stops making payments. The outstanding balance doesn't enter your estate. It isn't included in the estate tax calculation. It simply ceases to exist. For the IRS to accept this without reclassifying it as a gift, the note's got to include a premium, either a higher interest rate or a higher purchase price. That reflects the economic value of the self-canceling feature. This premium structure means the SCN works best for someone who's got reason to believe they mightn't reach their actuarially expected life expectancy, which means the SCN's the only legal financial instrument that's most valuable if you die sooner than expected. Not as a morbid observation, as a mechanical reality of how the instrument functions. Wealthy families have been using this for decades. It's been litigated in tax court, and it's been upheld. Method 4, municipal bonds. This one requires no move, no 10-year commitment. No legal document named after its own cancellation. It requires an investment account and the willingness to read past the word bond without dismissing it. State and local governments issue bonds to raise capital for public projects, roads, schools, hospitals. Investors purchase the bonds, and the government pays interest at a defined rate over the life of the bond. Here's what the tax code says about that interest. It's exempt from federal income tax, not reduced, not deferred, exempt by law, on every municipal bond issued by any state or local government in the United States. And if you purchase bonds issued by the state where you live, the interest's also exempt from state and local income tax. Federal, state, local. 3 layers of taxation. 3 layers of exemption on the same income, from the same instrument. This is called triple tax-free income, and it's been available to every American investor for over 100 years. Let's look at the math. If your combined federal and state tax rate's 30%, a taxable bond yielding 5% produces an after-tax yield of 3.5%. A municipal bond yielding 3.8% produces an after-tax yield of 3.8%. The municipal bond wins, not because the gross yield's higher, but because nothing leaves. The higher your tax rate, the wider the advantage becomes. For someone in the 32% federal bracket living in California or New York, a municipal bond yielding 3.5% is the mathematical equivalent of a taxable bond yielding over 6%. Wealthy investors run this calculation every time they allocate to fixed income. They buy their own state's bonds, collect the interest, and pay 0 to the federal government, 0 to the state, and 0 to the local government. Triple tax-free. Available to anyone. Hiding in plain sight. 4 methods. 1. Moving to Puerto Rico with a hard deadline of December 31st, 2026. 2. Utilizing qualified opportunity zones to eliminate capital gains. 3. The self-canceling installment note for generational wealth transfer. 4. Municipal bonds for triple tax-free income. The tax code doesn't ask what you earned before it offers you the same structures it offers everyone else. It just assumes you already knew about them. Now you do. Before you go, drop your answers in the comments. Which one are you going to use first? And which one made you the most uncomfortable? I want to know if those are the same answer.